Hello everyone! In this 5 minutes video, we would like to share with you some tips for doing renewable energy projects and matters to consider for both getting and providing debt or equity financing for those. It's not a secret that the success of attracting investors and financiers into a project is determined by so-called bankability of the project, being the combination of factors triggering the willingness of an investor or a financial institution to finance the project and impacting the attractiveness of the terms of such financing. Such factors can be split into several categories: legal, relating to title to assets, regulatory matters, various permits, etc., technical, covering technologies and service providers, terms of technical support, and so on, economic, including a financial model of the project, split and sources of financing costs, debt cover aspects, etc., and ESG-related, environmental, social, and governance criteria reflecting the sustainability level of the project. While there are lots of aspects which need to be considered by project participants, we will cover those in each category, which in our experience are not always taken into account, but which definitely must be in order to ensure the success of the project and its financing.
If you want to have a good project, you need to know what you're buying into. So first of all, do proper due diligence on the project, and not only legal, but also finance, tax, and technical. Secondly, you need to be sure that you have a company, the project company, in good standing. So do check the corporate rights, shareholders, their history, and also check the seller or sellers. Secondly, obviously, you need to check the permits to build the project, whether it's construction or permitting or zoning, everything that would allow you to start the construction as soon as possible. Then, most importantly, the land rights, whether this is lease or ownership title to the land. You will need to check whether there's anything that's missing for the title to be complete and not allow it to be challenged at any point in time. Check on which grounds the land rights may be terminated by the landlord. There's sometimes not enough information in the land ownership or lease agreements, but will be in the statutory laws. Check the price of the land, whether it contains any hidden taxes or indexations. Check encumbrances on the land plots, if any. Then we would usually check the grid connection rights, whether interconnection agreements and technical parameters of the grid connection are acceptable, whether there's any requirement to do infrastructure upgrade or reconstruction, because those would be quite costly, maybe quite costly. Check whose obligation it is to do it, whether it's DSO or TSO who can do it, or this will be additional burden on your project costs. Then visit the site physically. We always recommend that, to check out the surrounding areas, to check maybe there are some pipelines or power lines crossing the land plot. There's a river or water proximity. Possible flooding. Check access and public roads, because that's how you will be bringing in the equipment, and more importantly, it will be very crucial for wind turbines transportation.
Choose the right project structure to maximize financing options. First, stage and split the project. When it comes to a project of a significant capacity, say over 300 megawatts, relying on an external financing, it makes sense to consider implementing the project in several stages rather than in just one, and splitting it between several project companies. This is because finding financing of a significant amount from one lender may be difficult. Involving several lenders into one project may complicate the financing structure and, for example, involve senior and mezzanine debt, and otherwise make negotiations of financing terms between all parties involved more lengthy and complex. All parties will need to consider different interests of different stakeholders and find solutions acceptable for all of them. Instead, where the project is split in several stages, each ring-fenced via a separate project SPV, that would allow implementing each stage as a separate project of a smaller size and involve different lenders to different stages of the project, which would help to avoid conflict of interest. This is what needs to be considered from day one, as that would affect technical and other documentation and permits, and otherwise the structure and timing of the project. Second, involve contractors supported by ECAs. Where possible, involve contractors, whether general contractors or equipment suppliers, from the countries having export credit agencies. This can help get additional financing from an ECA or a contractor. Various financing structures can be employed depending on the circumstances. In such case, political insurance can also be sought, which would improve the risk profile of the project and maximize financing options. Third, manage the level of recourse against sponsors upon project de-risking. The key aspect to start negotiations of project finance with is sharing the risks between all the parties involved. So the first thing to agree on is the level of recourse against sponsors. Non-recourse and limited recourse project finance are seen quite rarely in the region. Still, strong sponsors can succeed in negotiating gradual release of sponsor support conditions along with project de-risking, which is upon technical and financial completion. We also recommend using all the possibilities of shifting the risks to other parties involved in the project. For example, use reliable contractors who are able to provide performance guarantees from either their parent companies or bank guarantees. Availability of such assignable guarantees serve as additional security of the project and improves its attractiveness for investors and financiers.
It's no secret that existing frameworks, which in our region, in Eastern Europe, in Central Asia and Caucasus, present many hedging opportunities to secure the banks, the financiers, and the sponsors of the project against adverse changes in the rates of exchange rates of currencies. And these factors, they sometimes, more often than not, determine success or failure of your project. So at the very early stages of renewable energy projects, you need to take into account whether those hedging mechanisms to ensure that the currency fluctuations are addressed, whether these mechanisms are available, how they work, and how they are addressed. The ultimate aim of this mechanism is to ensure that each party can understand its own risks when the currency fluctuates one way or the other. The proceeds of the projects would likely be in local currency, be it in hryvnia, in tenge, or other currency. And you need to take into account that these currencies traditionally have been subject to devaluations, and whether this happens or not in the future is a factor that nobody knows for sure. But this needs to be addressed, and there are various hedging opportunities which are available in the market and which need to be found and addressed. And for that, you need to consider them at the very early stage of the projects when you actually have the possibility to take into account the cost of these instruments, the likely regulatory issues, how to address them, how to structure the documents, which parties to involve, and who would be sharing the risk with you regarding those fluctuations. Lately, we have seen that some financiers are starting to provide loans in local currencies, but these are primarily for very short term and are not sufficient to cover the whole lifetime of the project. So in any event, the currency risk remains one of the principal factors which determines the success or failure of renewable energy projects, and this needs to be addressed at the very early stage. The other factor, which is also becoming very important and which in many respects is more important now than other factors, is ESG, environmental, social, and governance criteria, which the project must meet. Why this is important? Because for the last 10 years, many banks and financial institutions have decided that they would not be providing financing or any funding to projects which do not meet the ESG criteria. And this automatically means that funding for renewable energy projects would only be available if it meets these criteria. If it doesn't meet this criteria, the funding may not be available under any conditions. So this needs to be taken into account. So why and what specifically is ESG also needs to be assessed. Sometimes very untraditional factors could be regarded as meeting the requirements for ESG. Energy efficiency, noise reduction, protecting the natural habitat of animals. All of these could be regarded as good factors which will meet the ESG criteria. And the absence of those basically will prevent the project from being done. And of course, the huge bonus of ESG is that it often provides more competitive funding, more competitive cost of funding than funding which does not meet the ESG criteria. So to increase your chances of making the renewable energy project successful, you need to address those ESG risks from the very start to assess whether you will be able to meet these ESG criteria, assess how this can be done, what parties need to be involved, and how to ensure that you basically meet the ESG criteria.